How you doing?
Good. How you doing?
Very good. Very good. Weekend was good?
Absolutely.
Nice.
Hello, everyone. Welcome to the Money Storm Show. This is a place of discussion about all things money and how to weather that financial storm. Without further ado, these are your hosts, Chet and Larry. You have Chitanya Monga, otherwise known as Chet, the founder of Brightcap Financial, a commercial and alternative mortgage brokerage. You also have Larry Heron, the founder of City Center Mortgages, a residential mortgage brokerage specializing nationally.
Yes, sir. Thank you, Chet. Welcome back, everyone. This is episode 4, and we are excited to be back. Hopefully, everybody had a good long weekend. And in Canada, happy Family Day, which was yesterday, except for a certain few provinces. But let's jump right into it. I just want to get back into rates, Chet.
Absolutely.
They're just going up and down. When it comes to fixed rates, there's been movement, within weeks, like week to week, we see movements. A few episodes ago, I believe a couple episodes, maybe our first or second episode, we were talking about interest rates, and for new buyers, the rates being at 4.5%.
Yeah.
I remember, quote unquote, you were like, Larry, that's good money.
Absolutely,
And,
yeah.
it is good money. And now that good money's gone
by
like 20, 30 basis points.
It's still good money. It's
It
still
is,
good
it
money.
is,
You
it
know,
is.
anything less than 5 is still a stellar rate, right? Realistically speaking.
Stellar? But yeah, I mean, in today's world,
In today's world. And I
Yeah.
mean, even comparing on the international globe, like the
Yeah.
US has been on standard at 4.5 rates for over a decade.
Yeah.
Right? So speaking internationally, comparing global economies, we still have stellar rates available, right? With the US still being priced much higher than we are today.
Agreed. Those are great points.
Yeah,
right?
yeah.
Let's test you a bit there. But those are great points. And that 4.5% that we were talking about a little while ago, a couple episodes ago, has gone up by like 20, 30 basis points. That's like 0.2 or 3 decimal points. So 4.5 is now 4.8. And that makes a difference. That's all pure interest. Let it be an extra $100, extra few $100, which is just gone now. You can say goodbye to, right? That cell phone bill, internet bill is no longer, it's gone, right? So whatever it is. So everything's been going so volatile, and it's all based on the bond yields.
Absolutely,
right?
yeah.
And back to just some conventional rates, we were talking about 489. Conventional rates are anybody buying a home or refinancing more than 20% down or equity at 5.14%.
Yeah.
Slightly over 5%. Not bad. Not bad at all. But the new buyers, new to the country, 4.79, 4.69 maybe, still available, still good money like Chet said. And, if there is more movement with bond yields going up or interest rates going up, then, you could be getting a interest rate that has a 5% handle. And that's just not going to be a good feeling. So I think rates are still good.
Absolutely.
Buyers should get into the market.
It's important to note that realistically, with even 5% rates, there are some still rate discounts available in specific programs that exist to make your rate more attractive, right? So realistically speaking, even though we're seeing pricing at 5.14%, we can speak to our lenders. We can, go ahead and demonstrate the strength on the file based on your overall profile and still request lower rates. But this is just the introduction, and realistically speaking, yeah, rates are a little bit higher than they were just at a little while ago. So it's important to just note that, like you said, it's an adjustment of the bond yields being so volatile.
Yeah.
We'll see over the next little while maybe slight increases, slight decreases, just in reflection of those bond yields increasing and decreasing over time. And that's in relation to another topic we'll discuss shortly.
Yeah. So just to recap with interest rates, guys, a few episodes ago, we were sitting here talking about interest rates being 4.8%. Now the rates are, we were saying interest rates are 4.5%. Now the rates are 4.8%. They've gone up by 0.23, 30 basis points. And, that makes a big difference. So before these rates even go slightly higher or lower, act now. If you're in the market to buy, get yourself a 4% interest rate, something that starts with 4%, let it be 479, 469. It's pretty good money. Just a few episodes ago, we were talking about 449, 439. So act now, buy now. Real estate's a great time to get in always.
Absolutely. We've seen an increase over it with some of our existing clients and coming back into the market, and people selling their existing homes to either upsize, right? So it's definitely a good time to buy. There's a reason why there are people buying right now, and that's in reflection of the lower costs that we're seeing in the market for housing, and those discounts still being readily available, regardless of the rates being a little bit higher today, right? So it's definitely a great time to buy, and it's an interesting time in the economy.
For sure, for
Yeah.
sure. Moving on to the next topic, still related to interest rates for sure. Prime rate is still at 4.5%, the highest it's been since 2008, but it's at a pause right now. So the Bank of Canada, Tiff Macklem, our Governor of Finance, has said, he's justified himself with his most recent pause because inflation, which we talked about a few episodes ago,
Yeah.
December was at 6.3%.
Right.
And we were hoping that it would get into the fives.
Yeah.
January reports came out, and January reports for CPI, Consumer Price Index, has stated that the inflation rate is now at 5.9%. So inflation has been steadily coming down from that June high of 8.3. With these high rates that the Bank of Canada has been increasing and fighting inflation, we're at 5.9% now as of January. So Bank of Canada's pause has been justified. First time going against the U.S. Fed and everybody else in the G7
Absolutely,
nation. Few things that led this charge were cell phone costs decreasing and internet costs decreasing. Thank God, finally Canada has leveled up with the rest of the world.
Absolutely.
Maybe from all the complaints that people have been calling in to TELUS, Fido, Rogers, and all those customer service employees just getting call after call. Finally, they're like, enough is enough.
It's so crazy to say how inflation on a economic scale for the whole country is dependent on something so small as cell phone bills, right? But it's super interesting because
it's a monopolized industry.
It's a monopolized industry, right? There's only a few players in the market that control the pricing. And just to clarify, guys, yes, the overnight interest rate is at 4.5%. Prime rate is still at 6.7%. So with that said, there's likely no increases in the overnight interest rate, as you said, expected over the next few months, March, April, and we still continue to see a downward trend. And like you said, inflation was at 6.1 in December,
Correct.
And now we're saying
6.3 in January.
So sorry, 6.3 in January, and it's at about 5.9% right now. So I just want to make
sorry, guys, clarification. 6.3 in December, and now it's in January. It's come down to 5.9. Yeah.
Right.
January reports just came out. Yeah.
So with that said, that decrease, is just a clear reflection of our topic in our last episode, where we discussed that inflation is a delayed calculation, right? The CPI, Consumer Price Index, overall is very directly correlated with that, and of course, it's a delayed calculation by approximately 3 months. Just over a month, we saw a pretty steep decrease, in my opinion, to 5.9% on inflation, and we're likely to see that downward trend over the next few months as well, as inflation gets calculated. But again, it's delayed, so we're going to be seeing inflation numbers as of a few months ago, even though we're in our current events here, right? And we're going based on the news that's available today.
Yeah, exactly. Like, yes, inflation rate has come down to 5.9 in January, but like you said, there's still a few months lag, and there's some indicators and underlying things that we may not know about. So I guess the point of the story is take that positive news, and it's great that it's coming down, but the accuracy might not be there, and we should still be careful and watchful, I guess, right?
Absolutely. Yeah, food costs remain high, right?
Yeah.
Which is a reason for CPI being so high at this time right now.
Yeah.
It's important to watch out for that, because it's a major contributor to CPI and inflation. So let's hope that over the next little while that the supply chain issues, grocery stores, and all of these merchants will adjust their prices in reflection of inflation being adjusted. And keep in mind that they're seeing higher pricing on their end as well. So because inflation is delayed, their supply chains, their pricing, everything will be delayed as well. So over the next few months, we'll see that transition, and it's going to be an interesting process.
For sure. Just like the four big things that we talked about with this inflation, the four things that we kind of focused on was cell phones, internet service plans were the two main kind of the bigger factors that brought down inflation. And it's it's wild to think about how much of an impact cell phones and internet costs had on our consumer price index, but it makes so much sense. Internet and cell phone
Absolutely.
bills have
Yep.
been so much. Although gas, the fuel price at the pump has gone up and food prices have gone up, inflation still came down to 5.9. So, keep an eye on that. Food and gas has been rising, so be watchful on that. But cell phones and internet service costs have come down. A lot of Canadians right now are calling their phone providers, Fido, Rogers, TELUS. I'm one of them. I cut my bill in half from $90 down to like $45 a month. Nationwide plan, unlimited GB, what have you. The plans are competitive to the rest of the world. If you haven't called your service provider, call them now.
Absolutely.
It's in our best interest to call our service providers' internet and cell phone bills once a year, do annual checks on these things because prices are coming down. Canada's leveling up with the other countries. And, if you're paying over $100, that's like a dinosaur in cell phone plan. So
Yeah.
call your provider.
No, these are some quick budget tips that will positively impact your monthly budgets as a household. So it's important to just, make sure you're on top of it and realistically following trend with rates decreasing, gas prices decreasing, all that stuff, as they all play a major impact in our economy, how CPI decreases, how inflation decreases, and how we see a change in our interest rates over time as well. It's a one massive pie that's all connected.
Yeah.
Right. So often we don't think about these small little expenses and how they're going to affect us on a larger scale, but they're definitely correlated with one another, and they make a large impact on our basket of goods and how we go about living our day-to-day lives. Right.
That's awesome. I'm glad you mentioned basket of goods, which
Absolutely.
is how CPI is calculated, consumer price index, with every little niche
Yeah.
sector. And if gas has gone up and food costs have gone up,
Right.
your cell phone bills have come down and internet plans have come down. So
Right.
hopefully there's some offsetting there, right? Not
Yeah.
everyone's inflation rate is the same.
Absolutely.
So, some prices have gone up and some prices have come down. We're just not your average mortgage brokers. We are here to help out in every single department because, when it comes to getting a loan, like budgeting is huge. One of the first things that we do for our clients is work out a personal financial plan, work out what your budget is and what you'd like your payment to be. And we get into the budgeting. We give these tips,
Absolutely.
we look at your cell phone bill and stuff like
Yeah.
that. So we're here to help out in any situation for sure.
100%. And just because you may qualify for a mortgage, it might not be best suited for your budget, right?
Yeah.
So say you qualify for a $4,000 a month mortgage payment. Realistically, it just might not match your budget because you only have set up about $3,000 for your housing costs for that month. And again, it's important to set these goals into place because your budget makes a difference on overall how you live your life and realistically what your other expenses might be. So it's like you said, inflation is different for everyone, right?
Mhm.
Other people might be spending more on food or different types of food, like we spoke about last time. I'm
Yeah.
vegetarian, you're not,
Yeah.
right? So like there's definitely a difference in my inflation rate as opposed to your inflation
Parents
rates.
versus non-parents.
Parents versus non-parents, overall size of the household, how many dependents you have, all makes a
Age of your
significant
children,
difference. Absolutely.
babies, teenagers, toddlers,
100%, right?
school,
Babies are expensive,
university.
right? We
So-
talked about all this. So
yeah, everybody's rate's different.
everybody's rate's different.
Yeah.
So it's important to note that your max qualification is not your affordable monthly mortgage payment.
Yeah.
It's realistically just a reflection of what the bank wants you to qualify for. We, again, will review all this with you, and we're not your average brokers. We
No.
go ahead and help with your overall budgeting and kind of add some of our own insights into that because we understand that everyone has a different budget, everyone has different costs. So it's important to go ahead and
everyone
make note
has
of that.
everyone has a different mindset.
Absolutely.
And just a plan.
Yeah.
Like sadly, a lot of people don't have a savings plan, right? We've all been taught save what? At least save 10% of your income earned, if you possibly can. It's supposed to be 20 to 30%, but Canada's household income is just getting depleted with rising costs,
Right.
household costs, and sadly Canadians will get a chance to save. But we still talk about that. because you're supposed to save, right? 10, 20%, whatever it is. Some people will take, Chet was talking about $4,000 might be your qualification, and banks, maybe some brokers will be like, hey, let's go. This is your max qualification.
Right.
We take that max qualification. Okay, I'd like to maybe spend $3,500 for a home cost and have you maybe save $500 a month.
Absolutely.
Right? Who is doing that out there? Not a lot of folks, but we are. Right?
We definitely are, right? And like you said, everyone's goals are different. So for a first-time home buyer and as an investor, those goals are entirely different, and everyone has different sizes of income and also sizes of expenses. So it's important to note that, and again, be mindful of the clientele that you're working with and guide them in the right direction. So yeah.
The media won't talk about it, headlines won't talk about it, and now people won't talk about it, and the banks, they will not talk about it.
Absolutely.
But try to save. It's a really tough year to save, but we're going to keep hammering that point because you still got to do what you got to do to save and grow your retirement fund, right?
Absolutely.
So, yeah. Moving on to that, saving can only be done if your credit cards are free and clear, right?
100%, yeah.
So if you have credit card debt, you're probably not going to be able to save some money. So tackle those credit cards. We want to talk a little bit about credit at this moment in time. Credit cards are on the rise right now, and it's sad because there is no disposable income left, and Canadians are tapping that plastic, and those balances are growing. And the sad part is it's growing at 20%, and it's compounding interest. So it's your worst nightmare. That compounding interest, you want that balance to be in an investment account, which, we want to compound. But these credit cards that compound, it's a never-ending story, folks. If you've got a $10,000 balance, that's like $400 in interest, and it's compounding. So it's a scary story. If there's balances out there and, you're a homeowner, the bank said no to a consolidation loan, or there's no equity, even in a car, your options aren't done. Private loans, may or may not have a negative stigma, but there is so much positive finance work done with second mortgages. So if you've got credit card balances that are annoying you and are bothersome and have been, kind of like feels like it's going to be a never-ending story, then it's time to wrap it up into a second mortgage. You're going to cut your interest rate in half. So if you take $100,000 worth of credit card debt, hopefully you don't have that much, but just an example, sitting at 20%, we're going to cut that interest rate in half down to about 10, 11, 12% interest rate. And your payment's going to be interest only, and your payment should get cut in half. That savings that you get from the payment reduction, just apply that to your principal, and you should be able to get rid of that balance. But let's not have credit card balances linger and sit around. We want to try to pay that off, right?
Yeah, absolutely. The power of compounding is so strong, whether it's positive or negative, right? When we're looking at our investments, compounding on that end is super positive. It helps us leverage our investments and grow over time, and eventually sets up that retirement account and how our money grows so much quicker, right? But when we're in these situations with high interest rate debts in place, it's a never-ending story, right? It impacts the budget significantly on a monthly basis for families, and again, it affects a number of things, right? So it's important to note that don't stress about these situations. Call experienced individuals, have discussions that are important, have these discussions with them to figure out tips of how you can better yourself and better your lifestyle, whether you have a ton of cash sitting in the bank or whether you're completely on the opposite side and have large amounts of debt, right? And I mean, another thing,
if you don't have cash, we are equity rich in BC and Canada.
Yeah,
we are equity rich. Home prices have risen, and there's a plan there for sure to get rid of unsecured debt. Anything that's high interest, 10, 12, 15%, credit cards, right? Unsecured debt. So there's a plan for it.
Yeah, and it's important to note that it's not just about the compounding interest on these credit cards. It's important to note it's also about high utilization, right? On all these accounts, if you're sitting on high balances and flexion to your limit, for example, say your credit limit is $10,000 and your balance is $10,000 or close to that, you're negatively impacting your credit score on a daily basis, which reduces your future possibilities of acquiring good financing, bank financing, right? And of course, just negatively impacts your credit score.
Absolutely.
So we want to make sure that you're in your low utilization of your credits so you can have a healthy credit score and maintain that healthy credit score for the future years to come, right?
Yes. For investing, for
yeah.
buying homes, for getting credit.
Absolutely. Just really anything.
Getting cars, buying anything.
If you ever want to start a business, right, you're going to have all these issues that are in place. So we want to make sure that you maintain healthy credit files at a time when there's high credit balances across the country, right? So we just want to make sure everyone's in a good place and understands these important key factors which impact you guys on a daily basis.
Yes, guys, we're mortgage brokers, but we're credit specialists as well.
Absolutely.
Right? So we know how to repair credit, fix credit, build credit, establish credit, improve credit. Within 30 to 60 days as well. We have the tips, the tricks, the loopholes to get your credit into place. Now, you talking about these credit tips, I just want to share with our viewers, maybe share some tips because we are credit specialists. So I'm just going to share some credit tips, guys, how to keep a high score and how to be in the lending space where banks look at you as a well-qualified, established, credit-worthy person, right? So here's some tips. Here's my top 5 tips. Number 1, try to have a minimum of 3 accounts. So a credit card, line of credit, cell phone bill. But everybody wants to see at least 3 trades, at least 3 lines on your credit report. That makes you established. Number 2, like Chet said, use 60% of your max as like your max. So if you've got $10,000 limit, $6,000 is your max. Credit card companies and the credit card agencies, they don't like to see you be the top limit. So your score comes down gradually. It's all just an algorithm. The higher you are with your limit, your score is gradually coming down. If you stay 50% or lower, then your score is going to stay balanced. And if you actually pay off your credit card every single month, then your score is going to go up, right? Tip number 3 is use your credit cards and pay your credit cards. There is a lot of old schoolers might think like this, but you can't just have credit cards and not use them. You have to use your credit cards to build your credit. So the credit agencies give us a good score based on activity. If there's no activity, there's going to be no activity on your credit score. It's going to stay flat, right? Tip number 4 is pay on time. Never miss a payment. Pay on time. And tip number 5 is actually, I just said it, is never miss a payment. So that's it, guys.
Absolutely, yeah. And I want to make a note on point 3 there, where it was,
use your cards.
Use your cards. There is something called good activity, and there's also bad activity with credit. If you're consistently going to creditors, so we're going to go ahead and pull your credit. So you're car shopping. We see this all the time, guys, right? So we pull your credit file for the sake of getting you a mortgage. You've been car shopping. You've probably visited about 20 agencies that have all pulled your credit. That's going to negatively impact your credit score. So there's something called good activity and there's something called bad activity. So it's important to know that you do participate in good activities, and when it comes to other activities such as pulling your credit and how many times you do so, keep a note of that and don't let everyone just pull your credit for the sake of pulling it, right? These car dealerships will often reel you in by, oh, let's pull your credit.
They don't care about your credit and multiple credit checks and how much it's going to impact you.
They just care about the sale.
They want the sale.
They want the sale. So do not let everyone pull your credit. That is bad activity, right? You only pull your credits when it's absolutely necessary to do so. So just a point of that.
That's a great point. And it leads us to, like, us being brokers. That's one of our biggest benefits of using a mortgage broker.
Absolutely.
Is one credit check, and we can shop all the lenders. Now, and you get to save so much time. So imagine our consumers or clients going into a TD bank, watch your rate, get pre-approved, credit check, Scotiabank, credit check, this bank, credit check, credit union, credit check. It's like 5 credit checks, whereas we can do that for you. So broker benefit number 1 is one credit check, shop all the lenders, and we report back to you with the lowest rate. It's a win-win situation.
Absolutely. Yeah. And again, when you walk into these banks, it's the same story, right?
Yeah.
They don't care about your credit from that point of view because they don't know how many credit checks you might have done over the last little bit, right?
For the most part, they want to do the credit check to secure you.
To secure you as a client and as a potential mortgage holder.
We've already pulled your credit. Just run with us.
Exactly. So it's important to note that these institutions that are in place don't really keep an eye on your credit and focus on these things. Whereas when you work with professionals that understand all this stuff, they will make sure that your overall financial health stays green, stays positive, right? So we want to make sure that you are making good activity on your credit, you're following these key tips to maintaining your credit over time, because that's how we can best help you, right?
Absolutely.
So it's important to note that. So yeah, so Larry, you spoke a lot about interest rates and their
Inflation, credit
hikes.
cards,
Yeah, all that stuff.
private
So
loans, the benefits 20% down to 10%. So 50%
absolutely.
rate cut.
Yeah, yeah. So on that note, I just want to quickly discuss commercial rates, of course, just as a reflection
Yes,
of
I'm always excited for this talk.
yeah, just in reflection of residential rates increasing. We see the same thing on commercial rates as the bond yields adjust by 15 to 20 basis points, right? So that's 0.15 to 0.2%. We see the same increase in the commercial end, right? So as these rates increase, of course, it also impacts your overall ability to borrow money and how much money you can borrow from the bank. So it's important to keep a note of these things and make investments at times where interest rates are low, which they still are, right? And as bond yields go up and down, we keep an eye on that for you and make sure that we can get into times where we can secure strong interest rates that are beneficial for our consumers. So, but yeah, commercial rates, just like residential rates, have gone up by a little bit, and it really depends which commercial market you're
A
referring
little
to.
bit. I was interested. I was hearing a phone call that you were having, right,
Yeah.
with one of your commercial clients. I know the rates that are out there in the
Right.
commercial space, and I know you were dealing with a large deal
Right.
in the commercial space, multifamily homes,
Yeah.
and the interest rate that I heard being single digits,
Yeah.
and it being comparable to like institutions. I was quite
Absolutely.
shocked, Chad.
Yeah, yeah. No, that's really it, right? Like we do have access to lenders and institutions, private institutions that can work along with the banks to provide more attractive financing, right? So single digit
Gotcha.
rates, right? So realistically speaking, when there's the commercial world is so broad that it becomes difficult to narrow down a specific rate, because every program, every product will have a specific rate available. So whether you're in multifamily housing in terms of rental buildings qualifying for CMHC, whether you're going to go ahead and build, or you're doing construction, right? You're getting construction financing, you're
And
getting
that's
land financing.
mainly floating rates and variables for the most. Yeah,
Exactly, right.
always, yeah.
So it's so vast and broad, but it's important to note that yes, we do have access to lenders even on the construction side, which are able to provide single digit rates.
Like comparable to banks,
Comparable
and
to
these
banks.
are private commercial money,
Absolutely.
comparable to institutional top big five bank money.
Absolutely.
That's
Especially,
amazing.
like the private word is so scary to the average consumer when we're talking on the residential side.
Because you just
Right?
think high rates.
You just think high rates. It's scary. We get it, right? But in the commercial world, it's a completely different ball game, right? Privates offer a lot more, very like there's a lot of different
because the
factors.
foundation in the commercial lending space
Yeah.
is partnership.
It's partnership.
So that
Yeah.
money is partnering with you to make money too.
Absolutely.
Whereas I think that's the biggest difference in the residential world.
That's the
right?
biggest difference, right? And when we look in the commercial world, like it's a cost of doing business, right? At the end of the day, we might see some higher interest rates, and sometimes private is a little bit more expensive than institutional funds. But instead of going fully private, there are other options where we can bridge the gap and we can syndicate our private institutional lenders with our financial institutions like chartered banks in Canada to provide and like an averaged rate, a more attractive rate option, which is beneficial to the end business owner, right? Or whether it may be for construction financing, whether it might be for a commercial building, whatever it may be for, and it just offers more advantages because it's more fluid, right? There's less restrictions, there's less conditions on financing, and overall we can get more money rather than just competing with the financial institutions, but still mirroring their rates, right? So a huge benefit to working with private institutions and private lending in the commercial construction world is only growing. It's an ever-growing market as financial institutions get tighter and tighter, and as the financing situation and the real estate market in Canada is kind of in a position where it's difficult to determine what's going on and what's happening, and we're all guessing as to which direction we're going in, right?
From what I feel is institutions or mixed private lenders that are mainly focused on commercial products.
Yeah.
I think there's a very big opportunity for commercial lenders because
Absolutely.
right now, it's a land of opportunity.
Yeah.
So, anytime there's a recession or a low time in the economy,
Yeah.
there's also an opportunity in the economy.
Absolutely.
And that opportunity is obviously on the business side of things and on the commercial side of things. So lenders have a massive opportunity. I think they're starting to recognize this as well.
They
And they're
are
starting to
absolutely
compete with banks
they
now.
are absolutely starting to realize this and start competing with larger institutions because now they have the ability to do so, and it's an only growing market as we become equity rich, just like the average consumer, right? There are private lenders. Our average consumers are our private lenders, right? We have certain clients that have just been our mortgage clients and have transitioned into private lending roles who are now lending their own funds. In the private lending space and are lending their money out to getting strong returns. We're talking about returns at 7% to 12% to 14%, right? So realistically, we're talking about investing in our own real estate market, and still bringing you returns that are stronger than what banks promise you on mutual funds, GICs, and all these ridiculous products that exist out there. Promising you barely 2% on your funds when inflation's at an all-time high at 5.9% currently, like we just talked about.
Yeah.
So you're losing money on your investments rather than making money. And we are able to work with our consumers, right?
Yeah.
And teach you these tips because we do this all day.
Yeah.
Right? We just know what exists out there and what the opportunities are, so we can, just like you guys, take that path into better investments and walk you down the path, just like how we're guiding down the path ourselves, right?
Yeah. So, Chet, you've obviously dedicated yourself greatly. Like I've seen the commitment to the commercial space, so you can cater to your high net worth clients, your investor clients, maybe startup clients, but for the most part, your large portfolio clients. You focused on that, and here you are now. I wanted you to touch on with our viewers a little bit for. You use the word syndication. A lot of these private institutions now, especially for our high value clients out there that want to know the heartbeat and the pulse of the commercial lending space, Titania has it. He knows what's going on out there. A lot of banks might be saying no, but there's something going on in the back end. These private commercial institutions are partnering up with all sorts of people to take advantage of this opportunity. And Chet, syndication, what does that mean? And
you know what? Syndication sounds like a scary word, but all syndication is, it's a partnership, right? A simple partnership between two individuals or two parties. So in this situation, what we were just discussing, it's a partnership between a private institution, meaning private money, right? And it's a partnership with a bank. So again, bank pricing we already know is a lot cheaper. Private pricing is a lot higher. So when these two work together as one party, we can offer more attractive rates, more favorable terms.
They've brought down their risk.
Yeah, absolutely.
The fact that the bank is willing to partner up on this, that's amazing.
That's amazing. And it only shows that there's a reason.
So that's a trusted private lender.
Absolutely. And there's a reason why banks are willing to work with private institutional funds, right? It's because they see this space growing in the Canadian economy. And it's only going to grow more and more as more guidelines come into place and as financing gets a lot tougher from the perspective of Bank of Canada, OSFI, and these all different regulations that are in place, right? So realistically speaking, there are favorable terms out there, regardless of the type of investment you're in or investment you want to get into. And we have clients on all spectrums. We have guys that are building townhomes. We have guys that are building condos. We have guys that simply made
single family homes.
We have guys that made a lot of money from doing this and now are just private lending, right? And we have guys that are just investing in mix. So there's so many different forms, and it's such a broad industry that it's so difficult for me to be on camera and just try to explain it, right? But realistically, all we can do is offer you tidbits and little tips to kind of point that right direction, and which is why it's important to, again, talk to experts, talk to the people that that are in your community, right? And that are in these fields to learn about these tips and tricks, because a lot of people don't know about the investment opportunities that are in place for the average consumer.
Definitely. Right? There's a lot, honestly, I feel like you should speak to your startup builder.
Absolutely.
Because right now it's a land of opportunity. So, people know land is cheap, and, some of the the developers that now have cash sitting on reserves are buying homes. Some people that have saved money are buying homes. There's a lot of people out there that are now going to get into the world of building their first home, or maybe subdividing into two, and
Right.
taking these first steps before you go down the road of development. And I know you've done that yourself, and I know you've
Absolutely.
started somebody who's done their first home that came to you there for advice. Now that same client is building like a 10-unit townhome project with Chet. So
Absolutely.
like a startup builder, right? Like we
Yeah,
can
I
start
mean,
with you.
realistically speaking, like we've taken clients from just knowing the residential market, never have made a commercial investment, right? Or making a construction investment, whatever investment it might be. And we've taken them from the ground up and brought them along the different phases and taught them different opportunities that exist there so they can maximize their returns and we can get them the financing they need to do so, right? So like you said, like we're not just mortgage brokers, right? Like we go much deeper into our clients' lives and we go ahead and try to set them on the right path, whether it's through making the right investments for your family or just curating your budget to better suit your needs, right? So it's super interesting and really important to talk to your talk to the consumers and talk to everyone, right? Like the consumer should be going out and talking to the experts that are in place, whether
Yeah.
it's at banks, whether it's us, whether it's your mortgage brokers, the people that you talk to, right? Whatever it may be, but just talk to someone who knows what they're talking about, so you can
Talk to
maximize your
someone who
investments.
cares.
That's really
We
it,
care.
right?
Like at the end of the day, not every broker, but brokers care. We definitely care about, your financial well-being. We're not
Absolutely.
just in it for the transaction, which, quite frankly, like, we're in it for the relationships, right? We are here to build relationships, not make transactions.
It's important to say that.
Right.
I have clients that were first-time home buyers again, like 5 years ago, and now we're working with me on several different investments in the residential portfolio, considering commercial investments, right? So again, like you said, we're not transactional-based brokers. We are relationship-based, and we're really
Yeah.
just in it to take you down the right path, right? Because we actually care, and these are the investments that we're making. So we want to make sure that everyone's able to still grow and make these investments and be in a better position financially,
Yeah.
right? So,
That's
so
fantastic.
yeah, I think we catered off a little bit, but I want to talk a little bit about
Sure.
immigration
Absolutely.
and kind of how, like there's a massive housing shortage in Canada, all right?
Yeah.
And by 2030,
We're on the brink of it.
we're on the brink of
Like there already is a shortage, and
Absolutely.
now it's just going to exponentially grow, right?
It's just growing, right?
Yeah.
So like by 2035, like we're going to be short hundreds of thousands of homes, right? Because we just cannot keep up with the overall demand that's there. And that's in major correlation to the immigration that we see in our economy, right? And of course, we have to bring in immigration as well because our economy as a whole is not able to support itself without our immigrant folks, right? Our birth rate's declining, right? So we have to bring in we have to bring in
Wow.
immigrants, and that will help support the economy through employment, through spending, and all these different things. But the challenges we do face is the housing shortage, the crisis that we're kind of
Where
seeing.
is everyone going to stay?
Where is everyone going to live, eat, play, everything,
Yeah.
right? So with that said, there's a major correlation when it comes to international students, because what we're looking at is universities have increased their overall enrollment of international students without actually providing any new student housings in these markets, right? So that's only contributing to that housing shortage that we're talking about, because we see international students coming in, right? And of course, we need them to help our economy, but at the same time, universities that are increasing these enrollment rates are not providing student housing options, which is overall only leading further and further into the housing shortage.
Yeah. And we know it's happening because we're here in Surrey, BC, Canada, and there are a lot of one-bedroom basements with multiple students in them.
No, absolutely.
Right?
Yeah.
Yes, they're saving money and they just came to the country and it's cheap rent, but
absolutely.
also there aren't enough basements.
Yeah, you know
Our
what?
homes.
I was at a housing summit, right? I was at a housing summit a couple of weeks ago, and it's not just us talking about this. There's government officials talking about this. There's the federal government talking about this, and the federal government is working with municipalities to help support the housing crisis that we are facing because we do need more supply. And there is work being done in the background to help sort out this issue, but there's so much red tape. And again, realistically speaking, we just need more housing, and which is why construction is so important in our economy, because if we don't continue to grow, we are going to face a homeless problem, which is not good, right? It's a scary
But
place. And
everything just leads back to our large investors out there,
absolutely,
the home, the product, the home run product, and
absolutely,
it's the CMHC multi housing,
it's multi-housing.
the
And
best rates, best terms,
yeah,
and it's needed. The
yeah,
country needs it.
the country needs more student focused housing, right?
Okay.
And CMHC itself will also has programs in place
Provides that specific product.
for student housing. That's correct, right? So there are specific products out there. It's actually one of the most favorable products because student housing is a massive shortage. Canadian universities are increasing the enrollment rate significantly on the international spectrum um, because we just need more immigrants. And it,
Is
one important stat, I want to give this one important stat. We're the only G7 country which has a path to a permanent resident status for international student, right? So if you come into this country as an international student, you get a degree from a Canadian university, you are automatically in a much better position than any other G7 country in the world because they set you up with the right to permanent residences, permanent residentship,
Yeah.
right? So with that said, we need our international students to keep coming and help support our economy as well. But we're doing so because of the things that I stated, right? We have a declining birth rate in Canada. We need a workforce.
Yeah.
Put simple, right? We just need a workforce, and we need to be able to house that workforce as well. So there are programs that exist that specifically focus on student housing. But again, just even other products that exist out there, such as apartment buildings and things of that nature, we still need more and more of that because these students will become permanent residences that will support our economy by being a workforce, and they will need a place to live.
Absolutely.
Right.
Yeah.
So regardless of which asset class we're talking about, and there's a million different products that exist out there to support every single one of them, it's just based on the same factor, right? As an economy, we all kind of need to work together to kind of work on these issues that exist in our country, such as the housing shortage, because it's only going to get harder and harder. And it's simple. Economics is not that hard. It's supply and demand. The less housing there's available, the more the prices are going to increase. We're just like in any other economy, right? Like we're one of the top top real estate communities in the world when we're competing with large cities like San Francisco, New York. You know, these
Most expensive place to live.
Most expensive places to live.
We are the most expensive place on the planet, like as a country.
As a country,
the most expensive country when it comes to real estate prices.
Yeah.
In comparison to household income.
There you go. Right. So with that said, this issue is only going to get worse and worse unless we address this issue.
Those home prices are not coming down.
Yeah.
And
they're only
students,
go higher and higher.
like, you know, God bless you, work your tail off and buy a home as fast as you can. But most students are going to be renting for a bit. And now coming back to commercial developers are sitting on large cash reserves. There's cash flow is awaiting you with these products, and
absolutely
just do something so honorable and noble too to, you know, fill up our nation with homes and give.
We need it.
Yeah.
Right. It's not even about wanting to do so. It's not about maximizing profits. It's not about anything else. It's simply just to address the housing shortage crisis that we have going on in our country, and for us to sustain as a nation and keep growing.
Yeah, as a developer, put that on your website, put that on your builder resume. You know, it's about leaving a legacy. And, you know, if you can say you homed 500 students or 500 seniors, that's something, that's what we want you guys to be thinking about now, especially our high net worth developer clients that are sitting on cash reserves.
Absolutely.
Right?
And immigration is just so important to our country, as you know, like we see our economy is where it is, and if we want to keep continuing to grow at the rate it is, immigration, inflation, unemployment rates. These are the core topics that are in an economy, and there's talks of a recession. And we spoke about this on a previous episode as well. It's all correlated, it all works together. So the foundation just needs to get stronger and stronger for us to keep going.
Yeah, it was awesome talk.
Yeah, absolutely. It was a great episode, and
It was.
thank you guys for tuning in again.
We hope everybody found some value from that. And, you guys know where to reach us on any of these topics, or you want to talk to Chitanya or myself one-on-one, just contact us. Brightcap Financial, City Center Mortgages. We're on social media at City Center Mortgages, at Brightcap Financial. Reach out to us. Get in touch with us directly. Speak to us directly, not one of our team members. So on that note, guys, please remember everything discussed during these episodes is not financial advice, just information to educate the consumer, you, drawn from our personal and business experiences. If you have any specific questions about your financial situation, please contact Brightcap Financial or City Center Mortgages. I just gave you guys the contact information. Thank you again.
Perfect. Thank you guys. Subscribe, like, share, review, whatever it is, whichever platform you guys are on. And thank you guys for listening again. And we'll see you guys soon. Have a great day. See ya.